terms of traditional mutual fund versus a non-traditional alternative asset, what would be the difference, right? So, of course, generally speaking, mutual funds are created from the perspective of reducing the risk so that it appeals to most of the investors in general, because you can invest as low as 1,000. However, the non-traditional alternative investments are majorly catered for diversification objective. These are heavily regulated on the mutual fund side, whereas there exists lower regulation and there's more freedom to do with whatever you want to do to generate higher returns, right? Because as we will see in the future slides, that the objective of a traditional method in terms of return is very different from a non-traditional alternative asset class. So out here on the top, you can see this is if we are only investing in equity with no exposure in alternative investments. Now, when we do that, we obviously generate a slightly higher return of 16%, but we have a standard deviation of 24%, and we have a higher drawdown of 60%, which if you can see out here, this drop that you see, right, it is not protected because there is no alternative diversification which is available, and hence your portfolio drops to minus 60% at that period. You have a Sharp of 0.51 and you have a MAR of 0.20, which is nothing but return per risk that you're taking. Now, when you add a simple asset like gold in the asset, now you can see that the blue line, if you want, I can just zoom in a little bit here to show you better. You can see that although more or less the shape of the curve is pretty similar,